Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors.
Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. In this episode, I actually want to get into the concept of behavioral finance and specifically Stifel's Financial ID model. So, we know with investing that individuals really are on a journey, right? You develop an investment strategy. It's typically funded with hard-earned wealth. And then you watch as the investments change and grow over time. But it's really kind of emotional. We celebrate sort of the ups and we worry about the downs. And, when it comes to all this, basically, everybody's a little different. Some people get really into it, go deep into the markets, watch the news. Others really are pretty distant from all that. Some have great confidence in their own investment knowledge. Others feel a bit overwhelmed. And sometimes people want to be really involved in every decision, every trade decision, for example, while other individuals are confident, essentially delegating to their advisors and their experts. So anyway, in this week's episode, I want to get into the idea of Stifel Financial ID. It's a behavioral finance model. And it's really designed to help our clients better understand themselves and then work even more effectively with their Stifel Financial Advisor. So let's jump into it. The basic idea is we have this system. You take a questionnaire. It takes about 10 minutes, I think, to complete this thing. It's pretty straightforward, but it just asks a bunch of different questions. And it ultimately provides feedback on 6 different behavioral traits. So I want to go through each of those briefly and kind of explain it. So the first is risk attitude. So risk attitude really is gauging comfort and sort of how you feel about the possibility of future losses. So everyone's going to have a different appetite for risk. Some people will have a low risk approach and they may prefer sort of more lower risk investments, which translates to typically over the long term lower returns. But if you have a higher risk attitude, that may give you the capacity to basically earn a higher return by taking on a bit more risk and, knowing that there's an increased chance of losses, especially in the short term. Anyway, that's risk attitude. The second trait that I'll mention is composure. So this is just a little different in the sense that it really comes down to how you experience the actual gains or losses. So rather than a look to the future, it's sort of like, as this is happening, how do you feel when you have short-term gains or short-term losses? And the bottom line is obviously somebody with high composure can kind of tolerate that volatility in both directions. And that, again, allows someone to take a little bit more risk, which should translate over the long term to an enhanced return. But if you have low composure, again, a different dimension where you get anxious when these things are happening, that might ultimately lead you to, sell at a bad time, basically. If people get spooked about losses, they sometimes just jump out of the market. And that can be sort of difficult in terms of a long-term strategy that's designed to have a portfolio stay invested. So again, composure is a second dimension. The next one we call, in terms of a behavioral trait, is market involvement. This is really about how involved an individual gets in the financial markets. And essentially, you can imagine somebody kind of glued to the television, watching every tick, every move, or really focused in on economic releases or whatever, and how things might influence the markets. And so these individuals with high market involvement will be really close to the financial news, worried about sometimes how that's going to affect their portfolios, and they're going to like to actively talk about investments. So for example, with their financial advisor, they may interact with their financial advisor quite a lot, which is great. But I would say that the other end of the spectrum is someone who's really just not too involved. They don't particularly want to get involved in learning about the financial markets. They really sort of prefer to just work with someone that can handle things for them. And there's no right or wrong on all these things, right? That's just a continuum where we help people try to understand where they are. Next up is perceived investment expertise. And this really relates not so much to involvement, but a sense of confidence and self-reflection. How familiar and informed do you feel about your current financial situation and your investments? And in some ways, the more someone feels like they have a handle on it, the more relaxed and confident they can be about it, versus someone who maybe doesn't have a lot of confidence in that. And that means that, basically want to make sure to kind of explain things, but also do so in a way that can be sort of impactful with the individual. And so again, another trait here is perceived investment expertise. Next up is degree of delegation. So this is the idea that some people just have a hard time letting go of the detailed investment decisions. And that's okay, right? If somebody has a low degree of delegation, that means that they really want to stay involved. They want to understand every trade. And there's certain ways that our advisors can engage with a client who prefers that approach. But then if somebody doesn't really want to be too involved, they are more comfortable in effect delegating. So a higher degree of delegation would involve somebody saying, look, I'm going to hand this over, and I don't want to be involved in the day-to-day decisions. And we see clients all over the spectrum on that, as with all of these, really. Anyway, on a related note, the last trait that I'll mention is belief in skill. So this is a little subtle, but it really relates to the idea that as someone is considering delegation, it obviously should happen if they have confidence in that professional advisor, professional investor. And then, there's a whole industry basically of firms and teams that are looking to outperform the general market. And then there's a lot of, you can think about it, just the way things lay out. Some of them succeed, some of them don't. We have a body of work that we do called Manager Research, where we're trying to, really dig in on firms and teams and philosophies and process and identify things we have confidence in. But at the end of the day, you can't be sure, right? And so anyway, belief and skill would sort of tease out the individual client's preferences in terms of whether to use a professional investor to manage money to try to generate above market returns. And if the answer is no, like if you have low belief in skill, that's okay. There are a lot of products that really are designed more to provide market-like experience. And so that metric might help a client, an individual investor, along with their advisor, kind of navigate the different capabilities that are available and then use the ones that sort of align with those preferences. So listen, that's what I wanted to cover in this episode. Just kind of a quick recap of the Stifel Financial ID. And so really appreciate you taking the time to hang out, and look forward to catching you on our next episode. Thanks so much.
Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.